Hey everyone, welcome back to the Week in Charts, the show where I run through the most important charts and themes in markets and investing. Charlie Bilello here, and we have a lot to talk about this week, and I want to start with the exuberance that's back in the air. And if we look at market participants, why are they getting more exuberant? Why are they getting more positive? Well, simply markets are getting closer and closer to their previous all-time highs. So if we look at this chart here of S&P 500, NASDAQ 100, and Russell 2000, total return basis, last week, S&P 500 comes within 2% of its prior all-time high. We have the NASDAQ 100 within 3%, and the Russell 2000 still 17% below. So the knock all year long on the rallies in the major indices has been, well, the average stock isn't participating. So you can dismiss this. That's a harbinger of bad things to come. What we talked about is there's simply no evidence historically of that being the case. Yes, sometimes weakness in the average stock can be followed by weakness overall, but more often you actually see weakness in the average stock being followed by future price gains, where small caps with a lag catch up to their large cap counterparts here. And you can see that in the past few bear markets that we've had, the past few downturns, whatever you want to call them. We've seen this red line here, the Russell 2000 index, take longer to get back to new all-time highs. We saw that in 2015, 2016. We saw that in the 2018 bear market, saw that in the 2020 bear market. And this time around, we seem to be following that pattern again. So be careful. Doesn't mean that this is not necessarily a bad thing sometimes, but be careful with people that tell you, well, it can't be good for the stock market to have these small caps down more or not participating. It could mean that, but more often it just means that they're not there yet, and perhaps that performance is going to come later. And so far, that's exactly what we're seeing. So if we look at 2023 so far, it's not just a story of the S&P 500's return. It's what's driving that return that has people really positive. And it's really the story stocks that are out there, the AI revolution, mania, whatever you want to call it, but it has boosted sentiment far more than just a typical year where, let's say, all the different sectors are driving returns higher. I think tech, there's just an increased fascination with tech. And when these 8 stocks are doing better, market participants are feeling better. And NVIDIA, of course, leading the way. But it's not just NVIDIA. As of July 18th, all of the what I call the enormous 8 were up at least 40% in 2023. So if we look at the combined returns, so we had this huge down market 2022, huge up market 2023. When we put them together, we now have NVIDIA 60% higher overall. We have Apple 10% higher, Microsoft 8% higher. So we have things back at all-time highs. That's leading to more confidence. We have the major indices, Qs, SPY, within a few percent of new highs. And these other big leaders are not that far behind. What seemed like a huge insurmountable loss in 2022 has been largely erased for many of these companies. Now, if we look into the S&P 500 index, I put this out on July 19th. I think it was a surprise to a lot of people. The rally seems to be broadening over the last month. And what we're seeing is more stocks participating, more stocks up a big amount on a year-to-date basis. What we're seeing now is 86 companies up over 30% this year, 235 up over 10%. So it's not true anymore to say that it's just 5 stocks or 10 stocks that are up big in 2023. We're seeing that rally really broaden out. But in terms of sentiment, what has people particularly excited about? Well, it's extreme performance in a short period of time. So at this point in July, very rare for the S&P 500 to be up 19%. It's happened before, certainly. 2019 was a big year where you saw a big rally throughout the entire year. But before that, you had to go back to the 1990s, 1995, 1997, 1998 to see a year like this. So certainly not common to see this type of performance in a short period of time. And when you see this, as an investor, most people, they get more excited, they get more bullish. This is the opposite of the way I think. I get much more bullish when stocks go down a lot in a short period of time, but most people are the opposite. They get more excited when stocks are up. And what we're seeing now is this AAII sentiment poll show the biggest spread between bulls and bears. So bulls higher than bears, biggest spread at 30% that we've seen since April 2021. So very different picture from last September, October, when these sentiment indicators were giving among their lowest reading in history. You had to go back to the 08-09 period, 1990 recession, bear market to find sentiment in a worse place than last year. Now we have much improved sentiment. Is it extreme? That depends how you define it, but we're above the 90th percentile today. And what you tend to see from these elevated levels of sentiment is below average returns going forward. So it's not an outright sell signal. Doesn't mean stocks have to go down, but all else equal, you'd much rather be in the area down here as a long-term investor versus the area up here. So certainly investors can get more bullish and more greedy going forward, no question. And this doesn't mean, again, stocks have to go down, but as an investor, you'd much rather see people fearful than see people greedy. So it's not just AAI. We talked about the active managers last week. I want to touch on it again because it's gotten a little bit more extreme. So this is simply measuring the percent exposure to the equity market. And what we have now is active equity managers with a over 99% exposure to equities. And if we contrast that with last September, October, they were below 20% in terms of their exposure when the S&P 500 was down below 3,500. Now with the S&P 500 over 1,000 points higher, 30% higher. Now they're almost all in, over 99% exposure to the equity market. So something to watch here. A very different picture in terms of active managers embracing stocks today. They weren't embracing them last year. And as a contrarian signal, you would say, well, not that this has to be bearish, but certainly less bullish and much less bullish, I would say, than where we were last October. So what does this change in sentiment meant for multiples? What does it mean for expectations as we're starting earnings season? Well, multiples have trended higher. So prices are up, as we talked about, S&P 19% higher. And we're seeing forward earning estimates not go up as much. So what that means is the S&P 500's forward PE is going up. We're at 19 and a half times forward earnings now. We started the year below 17 times. So you're paying a higher multiple today than you were at the start of the year. And when people are paying a higher multiple, the translation of that simply means that they're expecting more out of earnings. They're expecting more from these companies going forward. So last year, they were not expecting a lot. Even last quarter, still not a lot. Now, very different picture. If you look at a company like Netflix, I think it tells that story pretty well. Stock was up over 60% heading into earnings, and it was a pretty good report. They beat on earnings. They added 5.9 million new subscribers. They had that new policy where you can't share passwords. That led to a huge boost in subscribers. And what did the stock do on this earnings report? Well, in the 2 days after that, stock goes down 10%. So good news, but bad reaction. And to me, that just means that short-term sentiment got ahead of itself. Investors were expecting a lot heading into that. And even though it, quote unquote, beat earnings, the stock is telling you that the true expectations were actually higher. And if we look at Tesla, similar situation, except I would say probably even more extreme in terms of expectations, because stock was up over 130% heading into earnings, one of the best performing stocks in the S&P 500 this year, beat on revenues, beat on earnings, and yet the stock declines 11% over the subsequent 2 trading days. So just a massive revenue growth number. Tesla continues to take market share, 47% revenue growth over year. But I think the big concern from investors was the hit to profitability, hit to margins, 18% gross operating margin, and that compares to 25% gross margins last year. So pretty big decline in margins. What's driving that? Well, higher cost is part of it, but I would say a bigger part of it is simply the price cuts that Tesla did across the board, talking about 20-30% price cuts on all of its models. And that has driven sales much higher. So we've seen this big boost in terms of revenue, but they're sacrificing profitability as a result of this. So Tesla has a strategy. We talked about this. It's simply take the market share for now. We'll worry about profitability more later. They are obviously still profitable, but not nearly as much as if they had a higher price point. But Tesla simply wants more Teslas on the road, and they think that they'll benefit from that ecosystem similar to the big tech companies in the future, either through services or something else. And their objective in the short run here is cut prices as much as they can while still being profitable, and that'll drive the number of Teslas on the road much higher. So expectations for Netflix, Tesla, very high heading into earnings. That's not true for everything, certainly not true for the bank stocks. So if we look at the S&P Bank ETF, KBE, first half of the year, it's down close to 20% on the year. Very different picture from these big tech stocks. And what we've seen after earnings is a pretty substantial rally across the board of all of these big bank stocks. Even little bank stocks are rallying. So up 12% so far in July, even though I would say the earnings picture is somewhat mixed. JP Morgan certainly standout quarter, had the first Republic acquisition, a huge increase in net income, 67%, huge increase in net interest income, revenues for JP Morgan, but kind of mixed overall. If we look at Goldman Sachs, opposite end of the spectrum, down 58% in terms of net income. Revenues declined 8%. But if we look at Goldman Sachs stock over the last few weeks since they reported, stock is going higher. So what that tells you is expectations for banks were very low. So it's not uniform in terms of this expectation game. It's really concentrated in the stocks that have done the best this year, particularly big tech, where expectations are very high today, much higher than they were in Q1. So let's talk about the Fed. And what I'm saying today is this week's rate hike is pretty much a done deal. And why am I saying that? Because every single meeting since 2008, since the end of 2008, we've seen the Fed do exactly what the market was expecting it to do heading into the meeting. And market is expecting a 99% probability the Fed's going to hike rates. So that's as close as you can get to a done deal. So the Fed's going to hike rates 5.25 to 5.5%. The question will be what the Fed kind of indicates from there going forward. So the market is expecting the Fed to pause after this hike and pause and stay there for this cycle, not go any higher. If the Fed gives an indication that it's going to do more hikes, well, perhaps there could be some type of reaction to that. We don't know. But I would say overall, though, is that has not been a good bet cumulatively since the Fed started hiking rates in March 2022. This whole idea that you shouldn't fight the Fed and that the stock market can't go higher with the Fed funds rate higher, well, that simply hasn't been true historically, and now once again is not true during this cycle. The S&P 500 is 5% higher than where the Fed started hiking rates on March 16th, 2022. And the Fed funds rate is 500 basis points higher. And after this week is going to be 525 basis points higher. So throw out these simplistic notions in markets that the market can't do something because of what the Fed's doing or anything else. That simply isn't the case. The market tends to go higher regardless of what the Fed's doing. And this is just yet another example of that. So what is the Fed going to do in terms of its balance sheet this week? Well, they're going to say they're going to keep shrinking it. I think QT continues here. We looked at last week, we saw total assets on the Fed's balance sheet decline to its lowest levels since middle of 2021. We're at 691 billion in terms of the total decrease from the peak in April 2022. And this quantitative tightening, in the beginning, everyone said, well, QT has to be bearish for stocks. That doesn't have to be the case. We've seen it before. We're seeing it again today. Stocks are actually higher than where they were when the Fed started shrinking the balance sheet. So all else equal is a balance sheet that's going up and Fed funds rate that's going down. Would that be better for the stock market? Yes, but all else is never equal in markets and investing. And that's what makes it so difficult, because what I would say today is if the Fed is forced to aggressively cut rates, let's say they have to move down to 2% rates very quickly, Well, that's not going to be good for the stock market because there's going to be some problem going on in the economy. You're going to have some type of crisis going on. Similar, I would say, similar things with the balance sheet. Because if the Fed is forced to reverse course here and start quantitative easing again after shrinking the balance sheet just 700 billion after a $4 trillion quick increase here, well, that means something is very wrong. So you want to see the Fed continue to normalize policy in terms of shrinking its balance sheet and keeping that real Fed funds rate well above zero to make sure that inflation is crushed. If they're forced to do the opposite, well, then you're going to have real problems in the market. I think that's a contrarian view today. But I think if you take a historical perspective, that's actually been the case. The last two big bear markets in the S&P 500, 2000 and 2002, 2007 and 2009, the Fed is easing policy the entire way down, and that did not prevent those declines. So let's talk about the recession. Q3 recession still on the table. If you ask most people, probably not. If you ask the conference board, who puts out this leading economic index every month, well, they are still saying, yes, Q3 recession, that continues into early 2024. What are they basing that on? Well, they have these leading indicator components, and most of them are still showing, projecting future economic weakness. The one big exception to this has been the stock market. So strong stock market return, not really at this point. Last year it was, but not this year, saying economic weakness is pushed off. But most of the other components showing weakness going forward. And if we look at their overall index, the leading economic index from the conference board now down 15 months in a row. That's the longest down streak since 2007, 2008. So they're basically saying it's only a matter of time. This time is not different from the 2001 recession or 08, 09 recession or 2020 recession. This big move down in leading economic indicators is going to lead to a recession. And they're saying not that far off. It's going to happen in the third quarter. So we'll see. We're seeing some signs of things, certainly not everything. We're seeing industrial production moving down on a year-over-year basis. So that would be one indicator showing economic weakness. Another one that I've talked about, retail sales, now up less than 1% on a year-over-year basis. And on a real inflation-adjusted basis, now you're down in negative territory for 8 consecutive months. That's the longest down streak we've seen since 2008, 2009. So these are two data points. Overall, we're seeing still economic data points of late beating expectations. Citigroup has this economic surprise index that measures that, and we're up at the point where we're seeing just a long string of beats here in terms of economic data points. Very different picture than what we saw last July. Now, for a stock market investor, I would caution you'd rather be investing for the long term down here because it usually means that expectations are very low in terms of economic data points. You're going to have more beats going forward. Up here, people are going to be adjusting their expectations higher because we've seen better than expected data overall. And if we look at the expectations for second quarter GDP, that's exactly what we've seen. The blue chip consensus, which is simply the average forecast from big major investment banks, has been going higher. It started out at 0 to negative, and now it's trended up to the point where they're expecting over 1% growth in the second quarter for real GDP. Atlanta Fed's estimate is over 2%. So no recession in the second quarter. The question is, will it start in Q3? And what the conference board is saying is part of the reason they're saying that we're going to see a slowdown in Q3 is they're saying there's going to be a slowdown in government spending. But I have to say that hasn't started at all just yet. If we look at the government spending, it's gone up and to the right, and we're seeing just a disconnect. And I would say don't try this at home, disconnect between what the government's taking in and what they're spending. So if you or I did this, we would be in trouble. But this is what the government's doing. They're taking in 7% less in terms of tax receipts over the last year, but they're spending 14% more. What's that leading to? A massive increase in the deficit, 2.25 trillion. This has certainly contributed to economic growth this year. We're spending a lot more money and we're not paying for it. We're borrowing it. So in the long term, we talked about there's going to be consequences for that. But in the short run, this is actually a boost to economic activity. Conference board saying this is going to start to reverse course. perhaps in the third quarter, enough to cause the start of a downturn. That remains to be seen. For now, the trend is more government spending, more deficit spending. And the big question is, well, how much will this continue before it hits some type of breaking point? So, housing market, we've covered this many times, but let's cover it again because we have more data points in terms of the shrinking supply. Redfin had this report put out showing housing turnover rates lowest they have on record. They have data going back to 2012. And where they're saying this is concentrated is in single family homes, and particularly large single family homes. We're seeing a 33% decline in terms of turnover versus 2019 levels. So, put simply, people are not selling their home at the same rates. We talked about the reasons for that. Biggest one driving that is the fact that mortgage rates have more than doubled. People don't want to give up those lower mortgage rates, or they can't give them up due to affordability issues, and therefore they're not putting their home on the market, and that's leading to a compression in supply. Overall, we're seeing about a 28% decline in turnover rates versus 2019 levels. And if we look at existing home inventories, this chart tells a very important story. We have US population 19% higher than where it was in 2000, and existing home inventory is actually 37% lower. I believe they said the adjusted for the month. So in the month of June, we've never seen existing home inventory this low, and data goes back, I think, to 1999. So extreme low levels of inventory based on the level of population and households in the US. We need millions more in homes, but what's that doing in terms of prices? Well, it's actually bringing prices back up. It was interesting from the existing home sale report. If we look at the median sales price, we're now less than 1% below the peak from last June. And so we've seen a 14% increase. There's a lot of seasonality to this. Of course, you tend to see higher prices heading into the summer months, and then prices come down in the fall and the winter as demand goes down. But in any respect, we haven't seen the big prices declines that I expected, many expected, because there simply is no supply out there. And so while we've seen demand go down, supply has gone down just as much, and if not more. And as a result, we're just seeing the activity collapse. The existing home sales, the number of sales, so number of homes that have been sold, is now down on a year-over-year basis for 22 consecutive months. Of course, that's the longest streak that we've seen since 2007, 2009. And this is extreme in terms of what it's doing to the housing market supply. So what we need to see, if interest rates don't come down, if they stay close to 7%, we're going to need to see a lot more home building, a lot more new homes. I think the home builders are getting a sense that that could happen, that conditions are going to lead to that. And so we're seeing an increase in this home builder confidence report from the NAHB pretty much every single month this year. And what they're expecting is that more of the housing market is going to be driven by new home sales than pretty much ever before. I think just this chart tells the story here. As a percentage of all home sales, you're seeing new single family home sales at record highs, like above 30%, where historically it's been much lower. We're looking at historically 10 to 15% range. But if you don't have any existing homes for sale, well, you're more likely to buy a new home. What they're talking about, how are they getting around this affordability issue? Well, they're actually building lower priced homes on average. So smaller homes, lower priced homes, and those are the ones with the most demand because of that affordability issue. So we're seeing a shift in terms of what builders are doing, but certainly they need a lot more building to come, and hopefully that happens because we need a normalization in terms of the housing market. You want houses to be affordable for people because you don't want to see the cost of housing crowd out saving and investing. I think that for anyone buying a new home today, that's what it's doing, simply because of the mortgage rate and the price is too high. And so if we can have more supply and lead to a more normal housing market, that'll be better for everyone, for mobility as well. So a big part of the US economy and jobs market is the fact that people are mobile, they can move to different states, different areas for jobs. But if these mortgage rate situation is leading them to be stuck in their homes, well, they're going to be less nimble, less able to do that. That's not going to be good for the U.S. economy looking forward. So we need more supply. Hopefully, the builders are going to build here. There's enough demand for that, and likely to see that shift until mortgage rates change, that shift to, let's say, lower priced homes in terms of what the home builder inventory is offering. So let's talk about, there was an interesting article out of the Wall Street Journal talking about the US versus Europe in terms of spending and wage growth and economic data points, and looking at the period from 2008 to today, and also 2019 to today. And interesting, I broke it down here. If we look at wage growth adjusted for inflation, US far and away the highest, over 17% since 2008. Germany and France up over 10% as well, but lower than the US. But if we look at countries like Spain, Italy, and Greece, they actually had declines in their wages adjusted for inflation. So a loss in purchasing power, loss in prosperity in those countries. So US is doing much better than Europe in terms of the economy. If we look at earnings, we would see a similar picture. What is this translated to in terms of the stock market? Well, I think you know it. We've talked about it many times, but I'll illustrate it here once more. Since the end of 2008, U.S. stocks have trounced European stocks. 562% total return for the S&P 500 ETF versus 175 and change for the FTSE Europe ETF. So this has been the longest trend of outperformance for US versus Europe or international that we've seen. And it's been driven, part of it, of course, is fundamentally driven in terms of US corporations. Earnings growth has been much higher, economic growth has been higher. But also at this stage, part of it is sentiment driven. So it's on the expectation that this will continue. So question that is always asked is, well, why do I need international stocks at all? Well, if we looked at the period before here, we looked at from 2000 to 2010, you'd see that European stocks outperform, emerging market stocks outperform. Is that coming again? We don't know. European stocks are actually doing pretty well this year. Obviously, US stocks still being driven by big tech, but we don't know what will happen in the next decade if this trend will continue or reverse. But this kind of explains the sentiment picture in terms of why people love the US stocks a lot more than European or emerging market stocks. It's simply been a case of extreme outperformance over the last decade plus. So remember the debt ceiling. I think this is fascinating how quickly people forget about something that was supposedly a crisis. And we talked a little bit about a credit default swaps and how they were surging to record highs. These are 1-year CDS, so buying protection against default on U.S. government debt. Just spiked higher, and now it's come right back down to it costs essentially nothing. It costs 4 basis points to buy protection today. So it's just fascinating to me how quickly people forget about a so-called crisis. As we said, this was not a real crisis. They were going to lift the debt ceiling. They did. The debt is now actually over $1 trillion higher in a little over a month. And you actually have investors saying, well, the U.S. is less risky in terms of whether it's going to default. So the U.S. is not going to default. You can't default if you have the power of the printing press, if you can just continually borrow more money. As long as that's the case, they're not going to default. But this is just yet another illustration of how quickly people can forget about things in the recent past. So, and there's nothing that makes people forget more than a raging move higher in the stock market. So just yet another thing in terms of sentiment. You don't hear anyone talking about this anymore. Obviously, nobody talking about the bank crisis that we had also earlier in the year. All of that's forgotten as long as stocks are going up and to the right. So I want to end with something positive, as I always do. And this is the trend in terms of what Americans are drinking. And the trend since 2005, 2006 is less soft drinks, much less soft drinks, much less in terms of juices. So less sugary things and more water. And that's great for all Americans. If we see this continue, that would be awesome. And so there's certainly been an obesity epidemic in the US. And this type of thing, not just this, but this will certainly help with that if we see this continue, and just overall awareness in terms of what we're putting into our body. It's great thing to see. So we'll end it right there. Have a great week, everyone. If you like the content, subscribe to the channel, and I'll see you next time on the Week in Charts.